Good afternoon. I'm Vinesh Chetty, AfriForesight's Deputy Chief Economist. For those who don't know us, AfriForesight is the largest mining research house in Africa, with a multidisciplinary team ranging from economists to engineers. We provide forecasts for Africa's key extracted commodities, as well as forecasts for major cost items required for mining and processing. We also do research on various African mining countries and extraction projects in these countries. In today's session, we deviate from our normal presentations, where instead of just focusing on how prices and markets will be shifting in the future, I'm going to discuss the higher level factors that drive markets as a whole to help you get ahead of the trends and navigate commodity risks. If you are not an AfriForesight client and would like to receive a complimentary forecast, you can contact our Business Development Executive, Sebastian Naidu, at his email address on screen now. Getting into these business cycles, it's always worth looking back at how the global economy has done. So what we have on screen is global GDP growth rates, and that's simply how well has the world economy done. When you see the bar is large up here, that means that the world economy grew rapidly that year. That's more goods and services being bought and consumed. And when you see the bar being largely negative, that's the world economy shrinking. People buying fewer goods and services, fewer products being produced and the like. Now, you'll see that this, again, does move. There are booms and busts in the world. The world doesn't grow at a steady pace. So you see over time, there are cycles, there are years when there's good growth, but that tends to be followed by years of bad growth. And then again, into the upswing we go. So this is a very natural cycle. This is part of how the world works. You, of course, get extremes, as we saw with COVID in 2020, but then coming off that weak base, we see these large growth years in 2021. But as I said, the boom and bust cycle is the nature of the world, but over time, the world does grow. Now, this is what has happened in the past, but what's coming up ahead? Well, to look at that, we have AfriForesight's global growth forecast. And while you see that 2023 is forecast to be a bit of a weak year, weaker than 2022 and certainly weaker than the great levels achieved in 2021, this is still a positive number. And that's important because you may have heard from some other forecasters and news outlets of potential for a global recession. AfriForesight is not forecasting that. AfriForesight expects that in 2023, the world will grow, mainly led by China, who has taken off their COVID curbs, effectively releasing the handbrake on the economy, allowing it to grow, as well as the still robust US market. While the US has increased its interest rates rapidly to try to fight inflation, they still remain an economy which is growing, and they're still adding jobs. So we see the US and China helping to keep the world economy positive in 2023. Going forward, despite those rising interest rates, which, while they are being used to fight inflation, often also have the effect of slowing down the world economy, we expect that with COVID restrictions taken off China, with the world which is getting back into the swing of things, more trade, consumers buying more things, that the world will grow at a steady pace going forward. And again, while it's not the great 2021 number, these 2 to 3% annual growths are good global growth, and the fact that they are positive numbers means that you can expect the world to be consuming more services, buying more products, and generally being in that good upswing that people like. And why do people like that good positive growth? Well, in the simplest terms, when the world economy is growing, particularly when it's growing well, that is the rising tide that lifts all ships. Whether you're mining gold or selling excavators, when the world economy is growing, people are generally happier. It's a better market for all going forward. Now, what about commodities specifically? Well, what we have on screen right now is a Bloomberg commodity index, particularly mined and extracted commodities. And again, you see here that there are cycles, there are booms and there are busts. There are some booms which are bigger than others, but there is a cycle of increases and decreases over time. Now, this is a mined and extracted commodities index. So that's your commodities such as crude oil, copper, and gold, along with many other metals and the like. Now, it's important to note that there are swings over time when it comes to these commodities. And while each commodity will have its own booms and busts, certain commodities tend to drive this overall index more than others. And one of the big ones that does shift the prices overall is crude oil. So you see the same orange commodity index as earlier, the extracted, mined and extracted commodities index. And you see the crude oil price here in blue, the Brent crude price, which most of us are used to seeing. Now, oil fits very well with this index. You particularly see here the 2008 run up and bust fits very well. But even at other times when oil prices are on the up, it generally adds upward pressure to other commodities. Now, oil tends to be a big price driver for mining itself. That's often diesel-based machinery. Also for rail and trucking, often oil use, and even for shipping, ships tend to use an oil-based fuel. So oil tends to be a big cost driver of commodities. Additionally, even if a commodity isn't directly mined or moved where oil is so involved, commodities tend to move together. As I said earlier, they tend to be in cycles, booms and busts. So you find that often over time, commodities tend to move together. And when that oil price rises, often you'll see other prices rising with it, particularly industrial commodities, which we'll get into a little bit later. Now, it's also worth noting that while these oil prices were very high as we got up into the $120 per barrel, it's worth looking a little bit further back and also looking at the effects of inflation. Now, what you see on screen here is the price of crude oil, but instead of being in nominal dollars, in just the absolute price of dollars per barrel, instead, the prices have been adjusted to 2021 dollars. And that's really just taking inflation into account and shifting the prices based on how much inflation has moved over time. Now, a big part of this is that there are simply more dollars in circulation today. So prices are generally higher because of that. As more money has been put into circulation, prices have gone up. Also, you continue to see cycles of booms and busts, and smaller booms and busts, but again, cycles of prices rising and falling over time. It's also worth remembering that while that $120 per barrel absolute price that we saw recently seemed high in absolute value, in absolute dollar terms, it's worth remembering that people have been experiencing very high oil prices in their own price ranges. So back in the 70s, these prices were very high given the average incomes that people experienced. It's also worth noting how rapidly prices can spike sometimes, and that 1970 spike is particularly important because it shows us how changes in the oil price can lead to changes in other markets. So when these oil prices spiked in the 70s, that led to rapid increases in the prices of petrol and shortages in certain countries. And that led to a change in how cars were designed and built. Before the 1970s, cars tended to be quite a lot bigger, particularly in the US market, and also were often rear-wheel drive. Due to that price spike, we saw a shift to smaller cars, front-wheel drive, with aims to be more fuel efficient. So in response to those high petrol prices, car makers tried to build cars that use less petrol. And again, that is the market reacting to a big shock like this oil price shock. And potentially looking at those oil prices in a little bit of a different way, instead of looking at the price level itself, looking at the annual price change. Again, you see that oil prices can be very volatile. That 1970s spike, particularly volatile. You see how rapidly the price increased over here. Now, this shows you that in context, again, that 70s spike was very hard on the world economy, and it forced the world into changing how it was using oil, how demand shifted over time. But again, you continue to see boom and bust cycles. As we said earlier, oil tends to be a good proxy for global commodity prices. So some booms and busts smaller than others, but in general, prices tend to swing over time. Now, so far we've been looking at how did prices react over time, but let's take a look forward. How is oil going to react going forward? Well, here at AfriForesight, our forecast is for generally declining oil prices. We saw that rapid run up in 2022 as Russia invaded Ukraine. There was a lot of concern around global oil supply, but we've seen, again, similar to what happened in the 70s, when there is a high price, the market tends to correct itself. It tries to do things to get around the problem. So Russia was effectively cut off from selling its oil to the West. So it's selling more of its oil to China and India, and countries in Western Europe are tending to buy more of the oil from the Middle East because China and India can now afford to buy less from those places. So the oil market is starting to stabilize. Additionally, we're seeing shifts away from oil towards more renewable products. And late in our forecast, around 2026 and 2027, we see that the EV market, the electric vehicle market, should grow so strongly that by that point, we expect petrol demand to actually drop off. There'll be so many EVs in your big developed markets that petrol demand should drop off, and that should lead to further declines in the oil price. So generally going forward, declining oil prices, and that tends to help keep down mining costs, shipping costs, and the like going forward. So that's one of your big factors is oil prices. But another big factor as far as global pricing goes is interest rates. When interest rates are very high, it tends to make doing business difficult. Whereas when interest rates are low, businesses and people can get the loans that they need or want. That tends to allow businesses to expand and people to buy more goods and services. Now on screen, we have US government bond yields. And in the simplest terms, this is a proxy for interest rates. This is effectively the interest rate that the US government pays on its debt. Buying a bond, in the simplest terms, if one buys a $100 2-year bond, you would give the US government $100 today. The US government would pay you interest based on this interest rate here. It would pay you that interest at the end of year 1, at the end of year 2, and after 2 years, it would give you your $100 back. And the interest rates that people pay on their mortgage bonds, on their car loans, on their credit cards and the like, tend to, over time, follow a very similar trend to these bond yields. You'll also note on screen that there are 2 different bond yields shown here. The 2-year yield is in blue, and the 10-year yield is in orange. Now, generally, the 2-year yield in blue is a little bit lower than the 10-year yield in orange. Now, why is that? Well, generally, when people are saving and people are putting money away, if they're locking their money away for 2 years, they're willing to accept a bit of a lower interest rate than if they're locking their money away for 10 years. When you're forced to put your money away for a long time, people want to be assured of a higher return on that money. And that is generally true. You see, generally, the orange line sits above the blue. But there are certain points, as we have right now, where the blue line is above the orange, where the government is actually paying more interest on a 2-year bond than on a 10-year. Now, what is that about? Well, that generally is a signal that the world economy is in a bit of trouble, because what's happening is those big money managers out there are saying, well, we think that interest rates have gone up and the world economy might slow down. And over the next 10 years, we don't think we can get that good 2-year again. We might get that today, but then in 2 or 3 years' time, the interest rate is probably going to be a little bit lower. So we're willing to take the slightly lower 10% interest rate today. Now, that is generally a bad sign when that happens. Looking at the gap between these two, again, you see that in general, the 10-year pays more interest than the 2-year does, but there are times when that is not true, as right now in 2023. We have the 2-year paying out more interest than the 10-year. And that's generally seen as a recession sign, that's an early warning that a recession could be coming. Now, when you look at the graph on screen right here, you see that when there is this, what we call an inverted bond curve, when the 10-year pays a little bit less than the 2-year, when the 10-year is giving you less interest for locking your money away for longer, that tends to be followed by a recession, which you see here in the gray bar. So we had the low interest on the 10-year followed by a recession. We had the low interest on a 10-year followed by a recession. So right now in 2023, we have that inverted yield curve. The 10-year is paying us less money. So there's a concern that a recession is ahead. But again, AfriForesight is not expecting a global recession. But interest rates have a greater impact on certain commodities than on others, particularly on gold. When you look at the price of gold shown here in yellow, and you look at the US 2-year bond yield, you see that in general, as bond yields decline, gold prices rise. Now, why is that? Well, bond yields and gold tend to be called safe havens. They're the kind of places people put their money, not necessarily for great returns, but for knowing that their money is going to be there later on. the US Treasury bond is considered the safest investment that one can make. But when it comes to gold, which is also a great safe haven, people have known about using gold as a safe haven for centuries. But the problem with gold is it doesn't pay any interest. When you buy a treasury bond, as I said earlier, you get your interest paid to you every year, and then you get your original money back. Whereas when you buy gold and you put it in the safe, you don't get any extra gold for that. You just have your original gold purchase there. So gold doesn't pay any interest on it. So when the interest rate is high, there's not that much incentive to hold gold. But when the interest rate is low and effectively zero, as we've seen at times in the US, suddenly that lack of interest on gold isn't as big of a problem. People are more willing to hold gold. So as bond yields have generally declined over time, we've seen that gold has generally increased over time. But now with bond yields rising, that is putting downward pressure on gold. But gold and bonds are seen as safe havens, and they help with what is called hedging. Now, hedging and diversification is all about trying to reduce exposure to risk. In the simplest terms, humans tend to generally be risk averse. That is why products such as insurance exist. Now, there's a very famous economic professor's introductory statement on this, and it's usually in the form of a bet. Economic professors will often stand up in front of a group of first-year students and ask them, would they take a bet on the flip of a R1 coin, often at a bet to start with R1. If I flip the coin and you get it correct on heads or tails, you'd win R1, or if you lose, you pay me R1. Who's willing to take the bet? And often everyone is willing to take the bet. And then the professor would ask, well, who'd do it at R10? And some people would keep their hands up, some would put them down, and repeat that at 100, and there's fewer hands up, and repeat at 1,000, there's very few people willing to take the bet. Now, the truth is, if you do the maths of this, the expected outcome of that coin flip is the same. It's a simple 50-50. The expected outcome is 0. There's no advantage to be had from playing or not playing the game. But the truth is, humans are more willing to bet R1 to win or lose R1 than to bet 1,000 Rand to win or lose 1,000 Rand. That is that risk-averse nature that most people tend to have. Now, diversification helps with reducing exposure to risk. If a company is involved in a single commodity, it is more exposed to that boom and bust cycle that we saw. So the boom and bust cycles come along. There are times when commodities are doing very well, and there are times they're doing badly. And particularly if you're exposed to a single commodity, if your company only mines or extracts oil and only sells oil, when oil prices are doing well, that's great, and your company's rolling in the money. But then when the oil price declines, now your company is hit by this one commodity decline. Whereas you often get first miners, now they will mine and extract multiple things, not just one commodity, but many of them. Now, when one of those commodities is in a big upswing, that miner doesn't see such a big upswing in its overall revenue. But equally, when there is a downswing in one commodity, well, now that miner is okay because they have multiple divisions. They can still make money from their other divisions. And it's not just miners. That's also the case when you're selling products. If you sell all your products to one type of miner, you're exposed to that income over time to that one industry. So by being more diverse, by spreading out over multiple commodities, you're effectively hedged against swings in that single commodity. So over time, being more diverse tends to help with that, reducing your exposure to risk. And certain commodities tend to move in different cycles, which can make different commodities effective hedges. Now, we talked a little bit earlier about industrial commodities being well linked to oil. What you see here in green is the Bloomberg Industrial Metals Index. And this is made up of copper, aluminium, zinc, nickel, and lead. And then you see the gold price. Now, while gold tends to do well when the world economy is not doing so well, we said people use it as a safe haven, but industrial metals tend to do well when the world is doing well. When the economy is in the upswing, more houses are being built, more copper cables, more electrification is happening, more aluminium windows are going in. So industrial metals tend to do well when the world economy is doing well, and gold tends to do better when people are more defensive on the safe haven side of things. So industrial commodities and precious commodities such as gold tend to be moving in different cycles. and that means that they can be effective hedges. Now, in the long term, as you see on screen now, copper and gold, while they do move in different cycles, over time, the truth is prices have generally risen. We spoke a little bit earlier about how there are more dollars in circulation today, and that means that prices have gone up for both of them many fold. And this is again about riding out the difficulties. Yes, there are downswings. You see here copper, which is the main industrial metal, and in gold there are downswings, but over time, both of these industries have done well. And going forward, AfriForesight is positive on the prices for both of these metals. Now on gold, we saw the price spike when Russia invaded Ukraine. Again, people use gold as a safe haven. When people are worried about what's happening, people tend to turn to gold. And our forecast is generally for gold prices to rise going forward. The truth is the world remains a scary place. We have an active war in Ukraine. We have China and the USA talking about spy balloons and shooting things down. We have concerns about what happens next for Taiwan. We have multiple flashpoints in the South China Sea, and any of those could turn into another massive conflict. And when people are worried about conflict, when people want to look for some sort of safe haven, for centuries, humans have looked to gold. So we continue to expect people to buy gold as a safe haven. Also, later in the forecast period, we expect that these interest rate hikes will slow down and eventually stop. And with interest rates not rising, that again means that people are more likely to buy gold. So we are expecting gold prices to rise over time. Copper prices, we also expect prices to rise over time. This is again tied more into the world economy. And as we saw a little bit earlier, while 2023 is a slow growth year, going forward, we expect the world economy to pick up. And as the world economy picks up, that tends to mean people buying more goods and services, and it also tends to mean more big industrial projects. There still are many electricity grids that need to be built out in the world. Developing parts of Africa and Asia still need to build out their grids. And even the developed parts of the world, with all those electric vehicles being put on the road, they need more copper cables, more charging stations. So we are generally optimistic on copper going forward. It's also worth noting that copper tends to be mined in difficult jurisdictions, both geographically and politically. The main copper suppliers are South America and Central Africa, the DRC and Zambia in particular. And the DRC and Zambia have problems with port and rail access. So Zambia itself is landlocked, so it has to export through its neighbors. And anyone who's ever tried to move commodities over borders in Africa knows how difficult it can be. While the DRC itself is technically not landlocked, it also has a difficult time moving commodities across itself and across borders through its neighbors onward for export. Similarly, in South America, mining up on high mountaintops is difficult. So geographically difficult in South America, also politically difficult. Both South America and the DRC and Zambia, these tend to be places where government can often make life difficult for miners. Now, because it can sometimes be difficult for miners, what that tends to mean is that there are high profit levels on copper. It tends to have very good margins. And that, again, is part of why we continue to see good supply. So we see supply coming online, miners want to mine copper, but the demand is growing rapidly, which is why we forecast these copper prices to rise over time. So now that we have a good idea of price outlook, how would we prepare for potential downturns? What happens if things go wrong, and how can we try to get ahead of this? Now, one of the big ones is attempting to reduce costs. In 2015, we saw that commodity prices were very low, and miners started trying to cut costs to keep their operations going. We realized, well, prices are low. How are we going to keep these businesses afloat? Because the truth is, miners, businesses are not charities. They need to at least be able to pay their expenses. So cutting expenses is one of the big ones. Then trying to reduce debt, particularly in the near term. We expect interest rates to rise. And as those interest rates rise, that makes it more expensive to pay for debt. So trying to reduce your debt would help to cut costs going forward. Also diversifying supply and customer bases. So again, if you're tied to only buying your commodities or your equipment from one supplier, you are exposed to a risk if that supplier goes out of business or there's difficulty moving products from it. I think we've all seen some of what happened during COVID. It got very difficult to move certain goods from certain places. Similarly, with your customer bases, if you sell into only one region and that one region starts to do badly, that could be very difficult. Whereas if you're spread out over multiple customer bases, then if one of them does badly, you could manage from the other ones. Similarly, diversifying your product mix. If you only sell one type of product and that business starts to do badly, you could take a big hit from it. But if you're supplying multiple different products into multiple different regions and you're buying your inputs from multiple different suppliers, that tends to allow you more flexibility in case of a downturn in one or more of these markets. It's also worth focusing on emerging trends. The world is changing what it buys and consumes. As we saw, when those oil prices spiked, car makers changed out the kind of cars they made. There was a time when business people were walking around with pages on their belts. Nowadays, we all have cell phones. So markets do change over time. So emerging trends, which commodities are looking good in the future? And here at AfriForesight, we are positive on battery making materials, cobalt and lithium and the like. We see good demand for those, as well as the hydrogen economy and rare earth metals. So we're positive on those, and we see those doing well in the future. So pivoting your business in such a way that it gains more exposure to those would also be helpful for a potential downturn in commodities in general. Now, what causes these downturns? What leads to storms? Well, there are general economic downturns. As we've seen, there is a natural cycle of booms and busts in the world economy. So sometimes when the economy's been running really well for a long time, that can in itself lead to high inflation, which can lead to central banks wanting to raise interest rates. Now, those interest rates, those bankers will tell you we're raising them to try and rein in inflation, which is what it can do, but it can also lead to a downturn. As those interest rates go up, it tends to lead to less spending, which is the idea of trying to cut down on inflation. Consumers who spend more on paying down their home loan and the like have less to go out and spend on other goods and services, but it also makes it expensive for businesses to expand, and that can lead to a downturn in the world economy. Wars, as we've seen now with Ukraine, can lead to changes in the world market, which can depress the economy of countries involved in the war. Now, even if you're not in direct war, diplomatic spats can also lead to problems. When the US and China don't want to buy and sell certain goods and services to each other, that means that you're not getting the most efficient trade. When you have seamless trade, barrierless trade, that tends to lead to lower prices. That tends to lead the most efficient outcome. So when you have diplomatic spats, when you have trade barriers being put up, that can lead to a downturn in the world economy. Changing consumer habits. We spoke about pages versus cell phones. There was a time people were carrying MP3 players and digital cameras. Nowadays, these things tend to get rolled into one. So there was a time when paraffin lamps were a very big thing. Other than ESCOM problems, in theory, electrical lighting has taken over. We also get those black swan events, things like COVID, things that no one saw coming. And those are really hard to be prepared for. But if you get your general business in order, if you try and diversify as much as possible, cut costs, you are generally better able to ride out the storms. And while there are events which can't be seen, the truth is there are a lot of events out there in the world which many businesses seem unprepared for. And these are things which we think are potentially likely to happen, which serious focus should be given to. So higher interest rates for longer. As we saw earlier, US government bond yields have generally been declining for decades. There is a concern now that inflation may become higher for longer, which means that interest rates might stay higher for longer, and that makes running your business more expensive. We've also seen a breakdown in global supply chains. As I said earlier, many of us saw how hard it was to ship things during COVID, but we're also seeing that certain companies are saying, well, I don't want to be exposed to China or Russia. I'm going to rather buy more things closer to home. But again, that means that you've got to be prepared for supply chains closer to home, costs potentially involved in that, changing out lead times. We also have a slowing China. China's still expecting to grow in 2023, about 5%, but that is slower than they've done before. And China is also seeing a declining population and an aging population. This is something we're seeing as well in other countries such as Japan and in parts of Europe. Now, a declining population means fewer people to buy goods and services. And also an aging population means changing out of goods and services. Older people tend to spend more on medical care and the like, but you're not going to, these countries are not going to have those young new workers entering the workspace, which means a declining working age population, which also places a lot of pressure onto the pension system. But overall, what is the takeaway? Well, there are difficult events out there. The world economy goes through upswings and downswings, but the truth is, ride out the downswings and the upswings will come along. Over time, the world economy gets back up, dusts itself off, and continues to grow going forward. Prepare as much as you can for the most likely events, set your business on a good, steady pace, and expect upswings over time. The truth is, given time, commodity prices tend to swing back and businesses tend to grow. Thank you so much for your time today. If you have any comments or questions, please feel free to reach out to us on the details on screen.